Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And today's Sunday, so we're just going to conduct a quick debt-free Sunday study group. It's a beautiful way to start a Sunday morning, right? And it's very sunny out there today, 8 a.m. or 9 a.m. right now. And let's just go ahead and get started doing velocity banking. So if you don't know what velocity banking is, if you happen to stumble on this concept or video for the first time, all it is a debt payoff strategy using lines of credit as your main tool. So in order to do velocity banking, there's only two requirements. So let's go ahead and zoom in right here. For the first requirement is a budget, right, which we've done. So if you take a look here, let's go ahead and zoom out, right? We have income, expenses, leftover savings, and what's important when we do our budget is that we list every single debt that we have, every single one, because a debt is essentially a hole in our cash flow bucket, and we're trying to maximize that cash flow. So if you don't have any debt, and let's say I only make $3,000 a month and I don't have any debt and my $3,000 of expenses and I got zero cash flow, this strategy could help you. It's for those who have debt, who have income, but we're trying to maximize our cash flow using lines of credit as our main tool. We're going to pay off this debt, right? And so now we've done our budget. We have to select a line of credit as our main operating account, okay? So the difference between this person and this person is not that much, right? Because this person's going to make the exact same income, or we're going to assume that they're going to have the exact same income, okay? But the other thing that we're going to assume, and this is something that they didn't teach you in school, is we're going to have zero savings. Nothing in our savings or checking account every time we get paid, right? I don't know if they taught you that, but I think a lot of people don't do this. But I certainly do this because I'm in a special club where I need to start selling t-shirts of zero in my savings, right? That's the special club that I'm in, okay? And the other thing that's different is that this person uses their checking account as their main operating account. Checking, savings, whatever's left over, bills come in a checking account, then they get paid your bills and you have $631 left over and you might think what's the big deal? Seems like a normal way of banking. Whereas this column, the main operating account is the quote line of credit, right? And some of you may have not even heard the term line of credit. You know what a credit card is. That's a line of credit, but there's other types of lines of credit like home equity and personal, and I got all of them, right? I got all of them. If you look at my personal profile, financial credit profile, I have over $258,000 in limits in lines of credit. So, for me personally, the reason that I got that much credit is because I took some classes, and one of the things that a credit instructor emphasized is that banks don't lend money to you when you need it, right? And so many people get angry when they hear that because we live in a society where people learn how to drive after they crash a car when it comes to finance, when it comes to real estate. Like they only want to learn once they screw up. It's like, what? What? No. Why do that? And so I learned again, I got to get the credit before I need it. And that's what you got to do too, usually, if you're going to do this strategy. But let's say you got three credit cards, right? Three credit cards, an auto loan, and a mortgage. We were smart and we'd even, get that student loan, right? I know people out there who make more than 200 grand a year and they're in their 50s and they're still paying their student loans, right? Like, if you're making that good money, why are you still paying student loans? And they make some excuse like it looks good on my credit report or something, right? It makes no sense, but people will do what they want to do. All right, so let's just assume that because we're a homeowner, we have access to a home equity line of credit, right? Home equity, okay? And we'll assume that it's like a credit card, but based on our home. And if you have no idea what a home equity line of credit is, look it up on the internet, right? But basically, it's based on how much your home is paid off and relative to the value of your home. Okay, but let's assume we have this awesome $50,000 credit card like type of product where we could pay anything. We can pay credit cards, we can pay auto loans, mortgages with this, and we're going to go ahead and use this as our main operating account to maximize our cash flow. Okay, so let's go ahead and do this, right? We're going to copy most of the budget, but we're gonna make a few tweaks. So I'm gonna show you what those few tweaks are. First one is definitely zero savings. Okay, I, I don't know if you're watching this video right now and this is obvious to you, but to a lot of people it's not obvious. Told my mom zero savings, she thought I was nuts. Right? I got zero savings, mom. Zero savings. Put all my income because I actually haven't gotten to the strategy yet. But let's just make a few tweaks before we get into the actual velocity banking strategy. So here's the thing, we want to maximize our cash flow, right? So one of the ways that you can maximize your cash flow is doing some transfer of debt, okay? So let's just transfer these 3 credit cards into that line of credit. So this is going to be 40K of debt, $40,000 of debt. And if you look at these aren't bad interest rates compared to other credit cards because sometimes if you go to a credit union, they'll give you lower interest rates than your standard Chase, American Express, those major banks where they're charging like 27 to 30% interest. Oh my goodness, right? But these are, credit union credit cards. We'll just assume that. But again, let's move this whole debt into that home equity line of credit. So this is going to be 40K, right? It's going to be 40K. And then we're just going to move this right here. Okay. And now let's take a look at what happened here. Well, if we simply transfer debt, guess what? These payments don't come up anymore. These debts are satisfied, okay? And then we're going to use our income minus expenses to determine, okay, how much this is going to go down by, right? So now we went from $631 in savings to zero savings, but what we're going to do is put our entire paycheck into that line of credit, take our expenses down, and it should go down by this cash flow number here. So here we were a little bit tight on the edges. Here we're doing a little bit better just by simply doing a debt transfer, and we're going to pay off our debt, right? The actual velocity banking strategy is entire paycheck into line of credit, expenses out, rinse and repeat over and over again. So what I'm going to do is just do a few formulas here. And we're going to calculate the next month's balance, right? And the next month's interest, or I'm sorry, to get the next month's balance, you calculate with the previous month's balance plus the previous month's interest minus our cash flow. Okay, so cash flow is 1784.83. And then now what we got to do is calculate the interest because every single month the interest is calculated. And you can use the average function to estimate it, right? Because it's calculated by the average daily balance. Multiply that by that interest rate, 0.1, this 10% right here. And then you divide by 12 to get that monthly interest rate. Oh my goodness. So all we got to do is copy these formulas right now. And then once we see either a 0 or a red number, that means that line of credit is paid off. So let's just take a look here. And then as you can see, it took us about, I got it in one try, 25 months to pay this off, right? 25 months. Okay. So let's go ahead and write that down as our milestone, 25 months to pay off 40K of debt, right? Not bad. Not bad. So we got this all covered, these credit cards that we were freaking about, that 40K of debt. Easy, right? You see how easy that was? And we increased our cash flow simply by doing this on day one. $630, which would make a lot of people sweat if you're making $5,000 of income, to $1,700. Immediate relief in the very beginning. Now, we have 2 more loans, right? We got the auto loan and we got the mortgage, okay? So, in general, if you've seen every single one of these velocity banking videos, I've never had an exception where the mortgage isn't paid off last. Okay, the mortgage is usually paid off last. And whenever you have an amortized loan, right? Whenever you have an advertised loan and it's at a lower interest rate than the line of credit, it's going to depend. Some people say on the internet, oh, you should always replace a loan with a line of credit, and I will actually argue against that. Because if you if the cash flow that you get is not significant enough to pay off that debt, right? Then you might actually pay more interest when it's not necessary. So at this point, it's going to be more about maintaining and managing your money and making it easier to pay off your debt by putting your money in one place and simulating the effect of overpaying your loans. So if we look here, we have the $1,700 that could potentially go into our savings account, right? But if we overpay our auto loan, we overpay it and put our entire savings into it, which who's going to do that, right? Who's going to put their entire savings into an auto loan and mortgage? And I don't know if you knew this, but most people have cash flow management problems, right? Most people have cash flow management problems, which is why they do a lot of refinances with their mortgage. They get a letter from their bank every 5 to 7 years. Hey, congratulations, you can refinance for possibly a lower monthly payment. And you know what's funny is I remember I got a 2.8% mortgage on my personal home, and the bank actually sent me letters to refinance for 7%. They, you know what I mean? Like it's crazy, right? So you know they ain't, you know, I think they're just putting out hooks, marketing hooks for fishing, and they're just saying suckers take the bait, right? It's crazy. Okay, so back to my point is that most people will not put the entire leftover cash flow directly into the mortgage because it's going to destroy their cash flow, right? So what we got to do is one of the ways that we can help alleviate this is just transfer principal into that line of credit and then dump our entire paycheck, take expenses out, and we have a lot more ease and flexibility there than just paying this directly, right? Okay. So let's go ahead and do that. And luckily, we have this Velocity Banking Calculator to help us deal with large amortized loans that are at a lower interest rate. That's what I love using this for. Anything where I could just directly transfer the debt from, you know, one debt to another, where it's completely paid off. I could just use Excel spreadsheet, but it's a little bit trickier, and just a little bit, not that much, when you have an amortized loan at a lower interest rate and seeing what the effects of doing this are. Okay, so now let's go ahead and figure out what the loan balance is at 25 months. So 22,000, 25 months. So now we've paid off, because it's been 2 years out of a 5-year loan, so we paid off a significant amount of it already. Okay, and actually, let me just do this, right? So is it worth it to just pay off this entire thing? Now, if it was with the 22,000 starting, I would probably argue no, but let's go ahead and calculate something called the cash flow index. And so all that is a number, an arbitrary number that gives you an idea of how much cash flow you get if you pay off the loans. Equals 13,494.89 divided by 415.17. So if you don't know where I got these numbers, it's the current balance divided by the monthly payment. And if you ever look at the explanation from The Wealth Factory by Garrett Gunderson, he's the one who came up with this concept. He says anything below 50 is what you call an inefficient loan, meaning that the amount of cash flow that this takes up compared to the loan size is way too much and you got to pay it off, right? And again, we can definitely do that. So if it was 22,000, I don't think we would. And again, you'll notice that when you do the cash flow index with credit cards, it's always going to stay the same. But with loans, because that payment is fixed, this number is eventually going to decrease over time. Okay, so hopefully that makes sense. So let's go ahead and move this over to that line of credit, and we're going to go ahead and do this, and then I'm going to add this and the okay. So now we just simply moved a payment to that line of credit, or the balance of the loan to the line of credit. And guess what? Oh my goodness. Increased our cash flow to 2,200. Mind blown, right? So let's go ahead. And now we're going to change this to 2,200 as our cash flow. Okay. And let's see how long it takes for us to pay this off. So in 32 months, now we've completely paid off the auto loan. Okay. So 32 months. And how much did we pay off? We paid off 62K. 62K. Oh man. 32 months to pay off 62K. And as you can see, in the beginning, it's a little bit hard to gain momentum. But man, once you've gained that momentum, the next debt just falls off pretty easily. Look at this auto loan. It didn't take us that long to pay it off. Just 7 more months. 7 months, more months just to pay off that auto loan. Mind blown, right? So now the next thing we're going to focus on is that mortgage. So now at 32 months, we got to figure out what that mortgage balance is, right? So let's go ahead and do that. $200,000, $200,000 at oh man, did my Excel freeze? My Excel's going crazy. Let's go ahead and reload this. Okay, $200,000 at 6%, right? 30-year amortization, meaning that the loan is going to go on for 30 years. And if you've ever never seen the math between before for a 30-year amortization loan, like a home mortgage, take a look at the amount of interest that you pay for a 6% loan. So you borrow $200,000, and at the end of 30 years, you're going to pay $231,000. Crazy. So it's like you're paying almost double for a house, or probably more than double. I don't know. And if you ever sell your house, if you ever buy a house and then sell it really quickly, you ain't gonna make that much money. Definitely not. All right, you're probably gonna lose money. All right, so now $200,000 at 6%, and we gotta look for that month, which is 32 months. So 32 months is going to be $193,000. And now let's go ahead and calculate that cash flow index at this stage. Okay, $193,000 cash flow index. The way that you calculate it is that balance right now, 193,109.39 divided by 1200. Okay, 160, 160. And let's just do a quick search on the cash flow index. And I think it's the Wealth Factory website, but I think Garrett Gunderson is the one who came up with it, right? Oh, not this one. Yeah. So how to use the cash flow index to quickly and safely eliminate your debt, right? And let's not put in our email right now. Uh, as you can see, we scroll down, loan balance over minimum monthly payment. 100 means efficient, means paid off last. Low, under 50 means inefficient, paid off first. So again, it's a ranking system. They got some examples here. I'm going to quickly like scroll through this. But what I'm saying is that you know, the whole point of this is to focus on the cash flow and not even the interest rate, right? Their interest rate, um, is completely ignored. And again, if you look at this is a viable model in knowing which debts to pay off. Okay, so let's go ahead and now this is the very last one we got to pay. We got a 160 fat cash flow index. Okay, well, so here we have this $2,200 left over. Now, what you can do is pay directly to that mortgage, but again, we have that same problem with that with any loan that we overpay a loan, we ain't going to get their money back. And some people say, why don't you use that credit card as a backup? Yeah, you can do that. That ain't going to help, but we want to prevent something called segregation of income, which is something I always go over in other videos, not this one usually, this type of video, because I could go on and on and on about human psychology and behavior when it comes to loans and why, banks know that they can offer a 4% or 5% interest loan for 30 years and make that into a 52-year loan because they know that you don't know how to manage your cash flow, right? Okay, so now luckily we have this velocity banking calculator where we just enter in the information, and so it's going to be 193,109. So 193,109.39, and all we got to do is enter it in, and that's the beauty of this calculator provided by Renatus. So if you're not a Renatus student, you don't get this calculator. People email me like, "Can I get this calculator? Like, are you a Renatus student?" No, I can enroll you, and they're like, "Nah, I'm good," but they want the calculator. Here's the thing: it's like they want the benefits, but none of the responsibilities. And if you want to be a good velocity banker, you got to study. You know what I'm saying? But this is where I first learned velocity banking from Renatus educational company, and I'm actually an independent contracted marketer, meaning I make money off of selling their education. All right. So now, what is the interest rate? The interest rate is 6%, right? and 30 years, and the payment will say it's 1,200. Technically not. It's like $1 less than this or something like that. And now we're gonna see how much money we move to that line of credit. Let's just move the same amount as our income, right? So we'll say 10%. And what is our expenses? It's everything except the loan we're trying to pay off, so it's 1,600. So here's the thing. Don't get so focused. Like the interest rate matters, but it essentially does not. And I'll tell you what I mean by that. So let's say that instead of a 10% line of credit, you're using a 30% credit card, okay? So I'm going to change this to a 30% credit card. So let's take a look at this. Right now, it takes 5.7 years to pay it off and $35,000 of interest that we're going to pay by accelerating the debt payoff, right? So normally we're going to pay $200,000. We now pay we're only going to pay about $35,000 and it's going to take us 5 years, 5.7 instead of the 30, right? But let's say, oh, I did this with a credit card because, that's the only debt tool I have. And there's probably ways to wash it out with like cash rewards points and all that if you're going to use a credit card. And again, you can't directly pay up a credit card to a loan. You got to use like Plastique or something like that. Well, we're not going to get into that today. But let's say, okay, so 35 grand is the interest that we're paying in 5.7 years. Now let's see what happens when we change this to a 30% credit card. Oh my goodness, 5.8 years and 40 grand, right? Like, again, the interest rate is not as important as the cash flow. And the other thing, too, is this actually gives you worse results based on the cash flow that you receive. Because, so if you actually move this entire thing, so let's say, you pay this off and you put the entire thing into that line of credit, take a look at this. You're paying $71,000 and 6.5 years. And that's why I say don't blindly just believe that, put all loans into a line of credit. It's about the cash flow that you get compared to the loan balance that you're paying off. Yes, the interest rate does matter, but it doesn't matter as much as you think it does, right? And that's a different way of thinking. People say C6, oh, that's bad. 9, that's worse. 3, like they kind of are all over the place with interest rates and loans, so they don't calculate, the holistic picture, which is your entire cash flow. So for example, it's like, if I get buy a rental property, it may be a good or not good deal for you. So, for example, one of the things that people focus on is always the cash flow of the rental property, but you have to think about the other benefits like the appreciation, the tax benefits, and all that stuff. But people solely focus on the cash flow. And so, if you have an emergency that's unexpected and the cash flow is not what it was meant to be or what you thought it would be, you might be have a hard time. But if that rental portfolio or that rental house is part of a larger portfolio, then it would make more sense to have that rental house where someone that's your only source of income, then you're going to have a hard time. So again, we have to think about the holistic picture. And let's just go down here. So $5,000 and 1,200, right? So yeah. So again, 5.7, 35 grand. Oof. All right. So we paid it off in about 5.7 years. So let's go ahead and calculate this. So 32 divided by 12, 32 divided by 12 plus 5.7. All right. So 8.3 years debt free. Oh my goodness. And that's 262K of debt. I really got to start. Once I get more traction on this channel, I got to hire a video editor. You know, I got to hire them to do like the zoom up, the close up, stuff like this, and then making some like neat effects and make it a little bit more clickbaity and just entertaining. Although maybe some people think I'm entertaining by myself, but yes, we are debt free after 8 years, and we paid off $262,000 of debt. And if this is zero, oh my goodness, after every year we're gonna have 3,400 in our actual savings account because we don't have anywhere else to put it, or we can just buy a rental property then, right? All right. Well, this is a Korean Atlanta mentorship. If you're interested in joining our group, go ahead and click the Google form link below. Other than that, I don't know what else to say. Happy Sunday, right? All right, happy Sunday, everybody.